Hi, everybody. Just giving a pause there so that everybody can join. I hope you've all connected now. Welcome to the Indian Steel Outlook webinar 2026. Kallanish has been running a few of these over the last couple of years, and they're getting more and more popular. Top 400 people joining on to this webinar, and we have representatives from 49 countries so far, last time I checked. So a nice international steel-focused audience to listen to this panel. I'm joined today by some esteemed panelists. We'll briefly introduce them before we move on to the first section of the webinar, which will be some presentations. I am joined by Ashwani Kumar Lal, who is Chief Steel Exports at Tata Steel, by Vikas Nahar, who is General Manager of International Business at Jindal Steel, Rahul Agrawal, who's Chief Commercial Officer at ArcelorMittal Building Solutions, and Gabriel Rosenberg, who is the founder and CEO of CBAM. And you will also see my colleague, Suhita Poddar, who is the steel analyst for the Indian subcontinent at Kallanish. Before we kick off, I just want to make a couple of housekeeping announcements. Firstly, if you want to ask your questions, there is a Q&A box. It should be at the bottom of your screen, and it says Q&A. Please go in and ask your questions there, because that's what I will be checking to share the questions to the panelists. Also, a reminder, if you see a question that you like, you don't have to ask the same question. Just upvote the questions that you like, and I will be more likely to see them. I'll see the upvoted questions first. Finally, just to say that the webinar is being recorded. There will be a recording made available. That should be available from tomorrow. So we do need to process it before it's made public. So don't expect that until tomorrow. Okay, so the format of the webinar is we will have two presentations. First from my colleague Suhita, who will be covering Indian steel markets, and then by Gabriel Rosenberg, who will be introducing status quo on CBAM and latest developments there. And then we will move on to the panel discussion. So we'll kick off. Suhita, please take it away.
Sure. Hello, everyone. I'll just give a very brief overview of India's finished steel outlook. I wanted to start off with the key takeaways or exact summary. What I want to discuss is India's story is going to remain structural and its growth as a structural growth engine for global steel, even as near-term trade-offs and cost squeeze plays out. Some of the key points I'll be discussing today is demand is going to remain structural. India has reverted to a net importer status between April through July of this fiscal. And in response to that, the government is tightening its trade defenses. On the export side, we're seeing exports diversifying because of narrowing EU access. CBAM, the CBAM portion, is being viewed as more manageable if it's optimized well. And finally, the outlook for the second half of this fiscal remains stable, but trade-offs persist. So going into India in the global story or global context, India is a key global steel market, outpacing global steel demand growth. If you look at the chart here, you can see that India is the second largest producer, and its growth rate, 6.1%, is outpacing the top 5 steel producers. The reason being, India is currently in a nation-building phase. So it's targeting 300 million tons of capacity by 2030 and 500 by 2047, and it plans to be net zero by 2070. Finished steel demand is also expected to increase from 160 in CY 2025 to 187 million tons in CY 27, which means India is going to account for nearly 11% of global finished steel demand. Post-monsoon recovery is also expected to increase sharply. in the second half of this fiscal, driven mainly by infrastructure, auto, construction, renewables, and other sectors. So overall, the growth story is very structural and long-term. However, near-term risks exist, such as the Middle East conflict, CBAM costs and MRV burden, and shifting trade dynamics. This is a snapshot of India's steel, finished steel. So the first number you're seeing, 54.28 is million tons, is the production, finished steel production, up 4%. The second number is consumption, and that's up nearly 8%. Imports are up nearly 37%, whereas exports are up 35%. So overall, India, April through July of this current fiscal is a net importer. And this is a reversal from India being a net exporter in the previous fiscal. However, demand and consumption remains very strong. And a lot of this is coming from policy as well as it's top down as well as bottom up. So it's being policy led. For instance, the government's capex is expected to reach 12.2 trillion rupees, about $126 billion in this current fiscal. And this is a major driver of steel demand. A lot of it is infrastructure. So that's roads, railways, housing, water infrastructure. There are several schemes the government has announced, such as the National Infrastructure Pipeline, Gati Shakti, and many more. Another driver of steel demand is manufacturing. The government has announced several schemes, such as production-linked incentive schemes boosting automotives, white goods. The government has also rationalized its taxation system, Goods and Service Tax 2.0, which is supporting manufacturing demand as well. Automotives and renewable energy is also emerging as very strong sectors driving steel demand for India as well. Another factor is a rapid urbanization and a very low per capita steel consumption for India. It's quite low compared to the global average. So there's a lot of room for growth in terms of steel use. Overall, India's demand remains policy-led, which is providing strong near to midterm visibility, even as the trade balance is currently negative. So this chart delves more into the import story. Imports are up 37%. If you look at this chart here, you can see that China is the largest share. That's where most of the material is coming into India. And China, Korea, Japan together account for 76% of imports. In terms of grade, HRC coil and strip is the most imported item. So in response to rising imports, the government has announced several trade measures. One is a safeguard duty, which was announced last year. It was announced at 12%, and it's a 3-year phase safeguard duty. It stepped down from 12 to 11.5% in April of this year. The government has also announced other trade measures, such as an 80 probe on CRGO, on HR flats. It's also introduced a melt and pour rule in its domestic procurement policy. So overall, they're addressing this pretty aggressively. Exports. The exports side of the story is also very interesting because exports are up by 35%. However, the markets, if you can look at the chart here, exports are also diversifying. Vietnam is the largest destination. It's up very sharply off a very low base, but also because of the current AD on Chinese material, helping India access this market. UAE is also up very sharply, and that's because of rebuilding infrastructure efforts because of the ongoing war situation in the region. Belgium and Italy are down by 43 to 37%, and this is because of tightening EU measures because of CBAM and the new safeguard trade regime in the region. What this means is that for Indian exports, for growth to continue, it needs to depend on accessible market. It needs to improve its competitiveness, and it also needs to explore different grade types because currently HRC coil is the most exported item. So it needs to go up the value chain as well. This chart shows a lot of information, so I'll just go through this a little bit briefly. So the first chart is flat steel domestic prices. There are a lot of lines here, but the number you need to look at, the green line indicates HRC, and the red line indicates domestic CRC, which are both prices for both are down very nominally, about 1 to 2% so far. The second chart is again flat steel export prices. It's showing HRC, CRC, HDGI plates, PPGI. The green line is again HRC and red line is CRC. Prices are down about 3% for both currently. And the third chart is rebar domestic, green and red. And again, both of these are down a bit more than flats, between 13 to 17%. So typically, domestic prices do turn softer during the monsoon season. However, what we're seeing is that flat prices are relatively range bound because of tighter supply owing to maintenance shutdowns, which is again very annual, it's an annual thing, export booking obligations, energy related disruptions. However, and prices are also relatively stabilized because of higher raw material costs and energy costs. Longs are also seeing tighter supply and higher RM and energy costs. However, because of a slowdown in infrastructure and construction, which is very longs heavy use, the prices are down sharply. What this means is mills tend to look into exports during this seasonally softer domestic season. So export prices are relatively stable. And even though it's facing a little bit of freight and logistics issues because of the ongoing Strait of Hormuz conflict, exports are continuing. Carbon. So green steel domestic demand is lagging. The 40 million tons that you're seeing here, that indicates the green steel supply target for the current fiscal. And while the supply target is relatively healthy, there's not really been much of a push in terms of domestic green steel demand. The government initially proposed an outlay of 150 billion rupees. However, that's been cut to about 50 billion currently. So a way to really encourage green steel use in India domestically is to prioritize certified green steel in public procurement. And this is a really important factor because about 25% of all steel comes from public infrastructure consumes about 25% of all steel in India. So prioritizing green steel in procurement will really support demand. On the export side, CBAM, the impact is not expected to be as high as initially estimated. So 428 million euros is what is currently estimated, or rather business as usual scenario. However, this overestimates the burden because India, there's different routes and different companies and plants have different emissions. So this is overestimating the scenario. 79 million euros is what would be the cost burden, the net CBAM cost burden for India if India uses its current technology or rather it optimizes its production without any additional investment. But this could even turn into a net benefit if of almost 44 million euros if India invests in low emission capacity. I believe AM/NS Hazira plant is already estimated to be CBAM compliant. Currently, the market estimates CBAM prices between 40 to 100 euros per ton, depending on the product. However, the sticking point for India currently is CBAM MRV. So while green steel domestic demand should be driven by policy procurement, CBAM MRV readiness is the current sticking point for India. This is more of a heat map of where India's export opportunities lie, depending on market access. EU is a bit more restricted because of the current protectionist measures. Middle East and ASEAN is where we're seeing more export being rerouted because of narrowing EU access. And untapped markets include Africa and South America. And while India is a global steel demand anchor, is not yet a structural export powerhouse. And finally, outlook. So the outlook for Q3 and Q4 is expected to remain stable, although pressures do exist structurally. So Q2, which we're in currently, there is a seasonal slowdown at the moment, which means mills are very much export focused. However, once we enter Q3 and monsoons are over, domestic demand is expected to see a sharp recovery. And then that is when exports will revert to its normal opportunity-based strategy. Another change that's expected to occur, or that is already occurring, is a shift in its product mix. So there's a higher move towards value-added steel, such as HDGI, PPGI, CRC, and other grades versus the basic HRC grades. And because of tightening or changing trade environments, India is also exploring different markets, as I mentioned in the previous slide. Decarbonization is also a huge focus for India. It's planning to launch its own carbon market, CCTS, very soon. And while execution is slow, India is in a good position to really lead in scale. However, there are some key structural trade-offs that will shape India's trajectory for the medium to long term, and that includes capacity addition versus demand absorption, because capacity tends to be lumpy, whereas demand is more of a steady line. It's export ambition versus ongoing trade barriers, cheaper imports versus domestic price competitiveness, specialized imports, especially for high-value grades, versus India's domestic capability building efforts, raw material dependence versus cost volatility, and finally, decarbonization versus affordability. If you want to know more about the India story, please do join us at our upcoming Global Steel Summit. Thank you. Over to you, Tom.
Thank you, Sahita. Lots to circle back to there, and we will do that in the panel session. Thank you for some of you already putting in questions in the Q&A box. Please feel free to continue doing so. Feel free to upload the questions that you like. But before we go to those questions, we will hand over to Gabriel Rosenberg from CBAM for an update on CBAM. Take it away, Gabriel.
Very much just trying to deal with a sudden burst of sunlight that's come in. I'm going to share my screen and then get started. Hopefully you can all see that okay. I'm Gabriel Rosenberg. I am the founder and CEO at CBAM. I'm joining you today actually from Brazil, where I'm working with clients in the steel industry. A little bit about CBAM. We are the specialist for CBAM management and policy. We have a combined service between software and advisory, totally focused on CBAM to help simplify compliance, analyze risk, minimize CBAM costs. We work with both importers and suppliers to Europe. We operate globally. I'm going to be telling you today a little bit of an update, a short update on what's going on with CBAM, Carbon Border Adjustment Mechanism that applies in the EU, that started, as you I'm sure are now aware, in January, and that is a sort of Schrodinger's cat situation, because it has begun, it is absolutely in force, and yet nothing is quite happening and people aren't sure what's going on. And that's because the EU chose to push the payment part of CBAM in year one into the year after, into 2027. And that has enabled them to get away with this problem that emissions data verification hasn't been able to get started yet. Verification won't be really possible until the end of 2026, when emissions, when the full year is in. And in fact, the verifiers, and we'll come on to this, haven't even been accredited yet. So the timeline here is not ideal for operators in India and indeed around the world. Nonetheless, no payments are needed till February 2027. Final emissions values, we do have a bit of time. We have until September 2027 when those CBAM certificates need to be paid to submit. But the cost is accruing today, and that is a real financial burden on the industry. What is the scale of that financial burden? Well, it's been a fairly stable couple of months actually in the EU carbon market since a bit of a crash earlier on in the year. We've got a CBAM price of 75 euros per ton of CO2 right the way through the first half of 2026. So what I'm going to be telling you about today is some of the latest policy updates and then giving you a quick guide to what you might need to focus on in your own businesses around the world. So the first thing to talk about is the expansion of CBAM in 2028. The reason I mentioned this is because that is where the activity is at the sharp edge of the policymaking process. So right now in Brussels, there are three different institutions that need to work together to come up with a final text. The European Commission has played its card. It has proposed expanding CBAM to steel and aluminium finished products, so kitchenware, gardening tools, machinery, etc. But the Council and the Parliament will also be involved in the discussion around this, and nothing is going to happen until January of 2028. We can be pretty confident that we will get a large number of products added to the list. I would think over 200 of them. Within those products, the carbon cost only applies to the metal element. So you may have a device that has a mixture of steel and other parts. You're weighing it. You're not going to pay for the weight of the entire device. You're just going to pay for the weight of the steel. There is a possibility that the EU is going to bring in a rule about country level cheating, so if they believe that a country as a whole is systematically trying to reduce their CBAM values, then through artificial means, then they will impose default values on that country and put the burden of proof that they are not using default values on the individual installation. So playing with the idea of shifting away from what is most important about CBAM, which is that every operator around the world is treated as an individual entity that can determine its own carbon costs. So we'll see where that goes. Now, another question that we get a lot about is the offset for third country carbon price. Inherent to CBAM is the idea that countries can offset carbon price if they are paying a carbon price in their own country. And the EU has set out rules for how this is going to work. And I'd say that they are not generous. It is true that any binding carbon tax levy or emission trading system in any country would be acceptable. They haven't drawn up an approved list of countries and systems that it does deem acceptable. And it's retroactively effective. Okay, so that sounds quite good, but actually, if you look at India's carbon pricing system, CCTS, that isn't going to generate a meaningful CBAM deduction for the purpose of CBAM. The reasons why, well, the compliance obligations are intensity-based, they're not absolute. And furthermore, the effective carbon price per ton for emitted emissions is very low. Compliant firms pay nothing. And this is something that we see globally in the carbon pricing world. Carbon prices contain a dual element of a payment and then an offset. And the EU is looking at the net figure and is going to require you to demonstrate that your net figure was what it was before it allows that to be an offset. You can't just point at the law and say the law requires me to pay X and therefore I've paid X. You have to actually demonstrate that the net amount you've paid is real, and then you can get that as an offset. And that's just not going to be substantial enough in the current Indian setup for it to make any kind of macro difference. There's been a fair amount of dialogue, strong dialogue at times between the EU and India on CBAM. But our message is that this is settled law in the EU at this point in time. Challenges, etc. at the WTO, certainly they have not got very far as yet. I think the EU has been reasonably adept on one point, which is getting its negotiating point across that this is a climate measure rather than a trade measure. They do believe that, and there is a lot of logic to that claim. While there has been pushback from India, we don't see we would strongly advise that manufacturers don't pay too much attention to that feedback and just really focus on what the law actually says, because it is going to affect their EU customers. In that respect, the message is actually quite simple. Um, the system rewards actual reporting, both in general and also when it comes to talking about the carbon price offset that we just mentioned. If you've got actual values from your installation that are verified, and then you are able to go further and get certified that you have had a carbon price paid, then you've got the best possible outcome for your company. But if not, you can use that default carbon price paid that will be added to the legislation, relatively unfavorable versus the actual certified carbon price, so even less of a deduction, but still quite good. But other than that, your only option is to report under default values. And then, of course, there's a default carbon price offset as well. And that's very much your least best option. For any manufacturer of scale, we would highly recommend that they work on their actual emission values reporting. It will be financially beneficial for them to do so, and there isn't a lot of time left. So that leads me nicely on to what matters for Indian operators now. This table actually demonstrates how much competitiveness hinges on verified values. If we take an example of steel billets with the 72071111 as the EUCN code, I don't need to work through the mechanics of the calculation here. Let's just go straight to the bottom line. A default value of 250 euros per ton could be reduced to a value of 90 euros per ton, or even 40 euros per ton for scrap EAF, just by getting actual values that are verified by an independent verifier before your customers start buying their CBAM certificates in early 2027. And so there's going to be a sharp differential between the companies that are low emissions and the companies that are high emissions. We just heard already about how the overall macro cost to India will be lowered simply because those low emission exporters are going to come to the fore. Typically, of course, those will be in the scrap EAF world. In fact, India, according to estimates we've seen from Sandbag and EU consultancy, has sufficient existing low carbon capacity to cover its entire EU export volume, especially for flat products. So not a bad picture there overall. If you are a lower carbon producer, you have a really excellent, I would say, once in a decade opportunity here to gain substantial market share if you can get your values verified. But there is not a lot of time. The EU hasn't made it particularly easy. They have only allowed verifying companies to apply for accreditation in the summer. The first accreditation is only going to come through in September, but we do believe it is going to come through for pretty much all of the big name verifiers that you might be already working with. Nonetheless, they have limited capacity. Verification is very much a human task. They have to come to your site in order to verify your CBAM report. Okay, so there are only so many verifiers on the planet trained in CBAM ready to come to your site in India. So I, again, make the point more than once, perhaps. You need to have that relationship with the verifier. You need to be asking them, are you ready to come to my site? Have we got you booked in? Have we got your capacity, your slot ready to go? Because that is the most finite resource right now in CBAM. It's the human verifier capacity bottleneck. It's a very substantial issue. So do get ahead of that one. And then the first verification reports will be issued in January 2027. Now, that's assuming that companies have got everything ready for that verifier right at the end of the year. But, they may not. And to be honest, there is a bit of flexibility then, because it's only in September 2027 that the customer has to declare and surrender certificates. I'm rattling through this a bit, but it's supposed to be a quick overview. Do come back with any questions. Verification is going to require very thorough documentation. You'll be familiar, I think, with the emissions reporting. That's sort of the spreadsheet that you may have encountered in the transitional period. You may be less familiar with the monitoring plan that is now required. The monitoring plan is the bigger piece of work. The monitoring plan is weeks and weeks of analyzing and documenting your process for managing your carbon emissions reporting under the CBAM standard, which is a completely separate standard to anything your team has worked on before. So do take seriously the amount of work that's needed for the monitoring plan. And if that's something that's interesting to you to talk about, I am delighted to follow up with you one-on-one in conversation subsequently, because we are helping a lot of our clients with monitoring plans right now. So summary checklist. Check your EU bound volumes, assess the value of default values versus actual values. And if there is substantial saving to be made, then proceed to your monitoring plan, to engaging with your precursor suppliers, selecting a verifier, booking an audit, maybe consider a pre-verification assessment. And then when you've done all of those steps, complete your verification, share your report with your EU customers. Really appreciate being able to talk to you all. Thank you very much to Kallanish. And just quickly to mention that we have just launched our monitoring plan software tool. That's something that I'd be delighted to demo for you. If you want to go to cbamboo.com/consult, I or a member of my team will be pleased to walk you through that and show you how you can save you time on your monitoring plan and AER preparations for CBAM. Thanks very much.
Thank you, Gabriel. That was really useful. I'd like to ask all the panelists to come back, to the cameras back on, please. Thank you. I will bring the other panelists in a moment, but there's one issue raised in your presentation, Gabriel, which is not technically an India question, but is important. This country level cheating, I mean, firstly, is it supposed to be a level playing field for everybody? Is there a particular target for that? Is it something that uh, China, India, or as the question was raised by somebody in Malaysia, that's so Malaysia, Indonesia, for example, are these possible targets for this adjustment to the policy?
We don't know. And I would say that this isn't something that's come out of the Commission. It's often the case that MEPs or individual countries in the EU Council will have a particular reason to raise a point in order to show that they are like making progress on some political concern. And to be honest, I think the political concern right now is the EU well enough protected against China? And so people can kind of throw that kind of idea in. And it maybe doesn't fit with the CBAM as a sort of logical structure. We often find that those things are weeded out in the process of negotiation between the Commission, the Council, and the Parliament, right? That's the way that the EU lawmaking works. And so it often does cause confusion from an outsider perspective, because people hear these things and then they think, oh, how's that going to work? How does that affect me? What's the way it's going to be implemented or whatever? But it's a couple of lines in draft legislation from one of the co-legislators. So I'm not sure if it will survive to the final text. I wouldn't be too worried, but my guess is it's been put there because of a country that has an even greater weight in the steel market than India does. That's my guess.
That's a great way of naming somebody without naming somebody. Thank you. All right, we're going to turn to the panelists. I think we're all interested to see how the mills are responding to this. So, Mr. Nahar, I wonder, as one of the major exporters from India, how do Indian mills respond to CBAM? How do they prepare CBAM? Do you feel that you're ready to minimize your costs in this scheme?
Yes, thank you, Thomas. Thank you for this inviting here. So, regarding the Indian mills, Indian manufacturers ready for CBAM, taking the CBAM. Yes, we are on the same level that we have pre-verified ourselves with the ETS approved agencies, so that whenever EU Commission announces about the authorities who can actually verify the actual emissions of the mills, we will go ahead immediately with the verification process. So all the mills, most of the mills are already pre-verified with one or two agencies, and we are just waiting for announcement of the actual verifiers. However, at the same time, yes, we are doing many trials or many innovations we are adopting to reduce our actual carbon emissions on whether it is iron making or steel making by adopting new technologies. We are discussing with the technology suppliers also that how can we reduce our carbon emissions. Yes.
Great. Mr. Lal, I wonder if you have anything to add on that and if you feel that all the mills are prepared.
Yeah, I'll just add. So, what he said rightly. So, the Indian flat steel manufacturers have a stake in the European market for a long time. And I think none of the players want to compromise on that. So, everyone is on the same page as long as far as the EU CBAM Commission allows us. So, they allow us pre verification till today, and that's where I think everyone is. I think the surprise element for India is the default value. I really don't know, or none of us know where the default value has come from. We don't know any mill which has that kind of carbon footprint. So that is something which no one is willing to explain to us. But nevertheless, it doesn't matter to people who are maturing in the CBAM process. We have the verified certifications. Exports have started in calendar year 2026. So I don't think there is much to worry. The point that we are looking for going forward is what can Government of India do in terms of CCTS and whatever allowances they can give us, talking to the European Union and FTA, etc. The other part, of course, is when we get the verifiers list and get the verifications done. So I don't see any discomfort as far as Indian steel suppliers going into Europe is concerned on CBAM. Of course, the quotas are a different game altogether.
Yeah, I was going to ask that exactly. Actually, the quota system is obviously also in place and is being quite significantly tightened, and the two policies interact with one another. Um, Considering that the total volumes from India to Europe are capped essentially by the quotas, do you see CBAM as something that impacts Indian competitiveness against other countries or competitiveness between mills within India exporting to Europe?
Is this to me? I'll
Yes,
take it.
please.
So yeah, so all of us are not on the same page as far as the carbon equivalent numbers are concerned in India. Neither are we at par with some Japanese or Korean mills for say. So yes, we are not at par, rather we are at a disadvantage when it comes to say countries like Japan, Korea, who have better carbon numbers than us. So I will not say that we are the best there. But amongst the Indian players, I think we are more or less on the same page, almost at par with each other. A few points here and there, so not much of what should I say, difference between the technologies that we all have adopted. But the bigger point will be on how much we can adopt new technology going forward and see how much we can reduce and how fast we can reduce, because the allowances of free whatever SFA will keep going up as we go down. So it is down time. So it's going to be important for us to see how fast we can reduce our carbon footprint in each of the units that we are exporting from. So some challenges, yes, but some way to go as well.
Thanks. Um, Gabriel, that's why I mentioned just there the Indian carbon trading system as well, and it's not yet meeting the standards for offsetting CBAM costs. Do you have a view on what it would take to uh, make it meet whatever standards the EU has set for that?
So I'm I go back to this point that a lot of companies will have lobbied quite hard to ensure that they have, offsets, free allocation, etc. And to the extent that they've done that, that's going to reduce the amount that they can claim back against CBAM. And so I don't think that they should be unhappy about that, because ultimately that is better for them. I think the difficulty is about proving about proving a negative, right? And I don't know how that's going to work. And how do you prove that you haven't been given a kind of rebate? In terms of what India could also do, I think you have to remember that the EU carbon price is exceptionally high by global standards. And so you would need to see quite a shift in other countries for it to start really meaningfully eating into the CBAM cost. But the option is there, the opportunity is there. It's another step in the verification. If companies are getting themselves verified on their monitoring plans and emissions report, then they should do so on the carbon price as well. That's one of the things that they should work on. I think over time, the CBAM is going to give a boost to domestic supporters of a more tough carbon price in a lot of different countries around the world, and I would definitely include India in that.
Right, thanks. Okay, we'll stay with exports, but a bit more general. We have a couple of polls in this session. I wonder if Caroline, could you put up the first poll on exports? I'll read this through, and then you can all put in your votes, and we'll see what the results are and put those to the panelists. So the question is, what is the biggest challenge for Indian steel exports in the next 12 months? CBAM compliance, weak global prices, Chinese competition, logistics and freight, the EU safeguard quota, or something else? I'll read it one more time just to make sure you've all had a chance to make your decision and vote, and then we'll check the results. So the question is, what is the biggest challenge for Indian steel exports in the next 12 months? CBAM compliance, weak global prices, Chinese competition, logistics or freight costs, the new EU safeguard quota, or something else? Okay, I think we'll take a look at the results. Okay, so it's quite spread out. There's obviously a lot of challenges for exports, but winning out is the safeguard quota into the EU, winning out over CBAM compliance as well, and over other kind of market factors like Chinese competition and weak global prices. Second place is Chinese competition, which is a perennial concern of any exporter, I suppose. I'll put it to the two exporters in the room then. What's your response to that finding? Vikas Nahara, why don't you go first?
Yeah, sure. So, yes, I think I'll also go with the first option only. First option means the highest voted option. Is that currently the challenge what we are seeing for the next year or maybe next to next year also is the updated, the revised TRQ quotas, because it's not about the CBAM which is stopping us to export to EU. It is only and only the new TRQ quotas where we have the restriction that only 149,000 tons of HR coil can go to EU only. And about that, if we exceed, then definitely there will be a duty on that, and which is also 50%. So apart from it, CBAM is easily being consumed in the prices. And yes, so overall, since EU has reduced the TRQ quotas for all the imports, definitely we are seeing for the upcoming years, initial 2-3 years, we are seeing a void in the demand supply gap. And there we are seeing the challenge that we can supply more even if the CBAM is there, because we are being ready for that also, but TRQ quotas are stopping us.
Yeah. Mr. Lal, do you have anything to add there?
I have a slightly different view, a little surprising. So the quotas are known; it's no more a challenge; it is a reality. So it's known for more than a quarter. So I really don't think in a changing world or in a fast changing world we should start getting worried something about which we knew and which has happened. My take is the second one, which is the Chinese exports or Chinese competition, which is actually that is one concern which I think all Indian exporters will continue to have for some time. Some of the countries have taken trade measures against Chinese exports or Chinese imports into their countries. And I think as China goes a little more berserk into exporting more into some regions, more and more regions will realize that they need to make sure that they have some duties against Chinese imports. So I think the opportunity for India will continue to be, in spite of CBAM, like Vikas said, CBAM is not a botheration for us. The opportunity for India will be growing markets. Besides India, of course, for exports, it will be growing markets where China is facing trade measures or China is not present in too large quantities because they are interested more in quantities. I think as India, we should be looking more in terms of value rather than quantities for exports. That's my take.
Yeah, so I also want to correct myself. Like, my answer was for EU exports only. Definitely, this is opening up. Lot of restrictions are coming up for Chinese exports, and that is opening up opportunities for Indian exports. So definitely, I go with Ashwini sir that we are. It's an opportunity for us that we are going to explore, new different markets. We are going there, and we have started exporting to those countries, which we were earlier not doing. So yes.
Yeah, and that brings it was going to be my next question was around export diversion, right? Obviously, if you're having exports reduced from to the EU and to other regions, it has to go somewhere. And Indian steel capacity is still growing very, very rapidly. There will be more exports, right? So, is there a danger for you as exporters that at some point you become seen almost like the next China, the next market that exports large volumes of steel into smaller markets uh, in order to, increase utilization at their own mills at somebody else's expense? Do you see that as a risk going forward?
Can I answer that?
Please go
So
ahead.
yeah, so no, so we don't see that there will be any like risk in that, because at the same time we are gearing up with our with increased capacities, but it is not only for exports. Definitely, India is also like growing, and with growing, we are having a lot of opportunities. There are several government projects are coming up, so there will be equal demand in domestic market also. At the same time, world is the market. So it's not about only specific geographies where we can supply, where we can export. There are a lot of other markets out there which there we can supply our steel. So yes, like you said that US, Canada, like in Suhita's presentation also. So these markets are there where definitely there are tariffs, certain tariffs, which is hindering the exports from India to US. Like, but definitely there are other products. There are specific products which we can export and which we are doing also. So there's an opportunity, and which will definitely reduce the risk of being next China.
Thank you. We've been very focused on exports so far, and the other two panelists have been very patient and quiet. So we will turn a little bit to the domestic market as well. I'd like to maybe kick off with another poll. Caroline, can you bring up the second poll, please? Okay, so as again, multiple choice, please add your votes whenever you're ready. The question is, which emerging sector will drive India's steel demand the most in the coming years? Renewables and green energy, AI data centers, EVs and mobility, commercial real estate, or aerospace and defense? I'll read it again so that you can all take a look through and vote. Question is, which emerging sector will drive India's steel demand the most in the coming years? Is it renewables and green energy, AI data centers, EVs and mobility, commercial real estate, or aerospace and defense? Okay, I think we'll take a look at the responses and we will put that to our panel. Okay, here we are. Okay, so there's two fairly clear winners. Commercial real estate is number one, which I think would have been my vote as well, I have to say. So commercial real estate at 31%. The close second space, though, is renewables and green energy at 27%. Uh, Aerospace, defense, and AI data centers and EVs all scoring lower, despite being fairly regular talking points. So, Mr. Agarwal, I wonder how you would respond to that. Obviously, good news for you as a building solutions provider.
Hi, good afternoon, everyone. So again, I will also like to go with the poll, but I will also like to add that the if you see the Indian economy or the Indian consumption in the steel on the segment wise, so just to give you this snapshot, so we are consuming around 160 million ton annually, and we are growing at CAGR of around 8% annually, which so we are the one of the largest, fastest steel growing economy as on today. If you talk about the segment, so we consume around 65% into the infra and the construction, around 10% into the automotive, around 10 to 12% in the engineering, 5% in the white appliances, and rest into the other segment. If you talk about the all the sectors which you mentioned your poll, so the renewable, where I'm also very positive in terms of the demand in the coming month. If we look at the current solar capacity in India, so we are somewhere at around 160, 165 gigawatt installed capacity, and with the government ambitions to reach around 500 solar capacity by 2030, so which will require to add around 50 gigawatts every year, so which will consume almost a million ton of steel, just a basic by the thumb rule. Also, there are a lot of windmill projects in India currently going on, so that will also consume a huge amount of the steel, and especially the nature of these the renewable energy projects and the geographical area where they are coming, they will not only demand the big quantity of the steel, but they will also demand the special quality of the steel where the corrosion resistance to corrosion, especially in the excessive challenging environment, is very important. So this sector will not only bring the volume, but it will also bring the value-added product. Second, also, the sector which where I am optimistic is the data center. It's a new in India. Currently, the steel consumption in the data center is relatively low compared to the other sector. But as I mentioned, there are many data centers. Currently, the installed capacity, if I am not wrong, is around 1.6, 1.7 gigawatt. 1.3 gigawatt is already under construction. 5 gigawatt is already approved and ready to start the construction. So again, this data center warehousing will also consume huge amount of the steel. Again, with the steel with the value addition. Yeah, so that's my take, Thomas, on this.
That's good. There's lots of nice numbers there. I'm going to have to check out the recording and note some of them down. But it seems, I mean, the basic Indian story seems to be that almost everything is growing, which is a very nice situation to be in if you're anywhere else in the world. There's also a question about supply. So there's a question that we had in before the webinar from one of the delegates that was about the market share between major mills and smaller mills. They were talking about rebar, but construction products in particular. India has a very large informal steel sector. How do you see that market share currently, and how do you see that developing as the general Indian construction scene develops?
Okay, so as I mentioned, the current market is around 165 million ton. If we see the share between the primary and the secondary, so the secondary mills are more into the long products, which is around maybe 95 million ton. And if we divide this 95 million ton between the primary and the secondary, so I would say the dominant, the majority of the market share is with the secondary player, which they command around 70% market share, and the 30% market share with the primary, more on the rebar side, which goes for the construction, more into the construction segment. I personally do not see any structural threat to the secondary market, because they have the added advantage over the primary. Of course, they cannot compete with the single mill in terms of the volume, but of course, the geographical location, so they are closely located to the end user, where they have the advantage in terms of the logistic cost. They are also offer the immediate service to the construction segment, and that's how the construction segment works. Because if they need material yesterday, they will give you the order by today. So that's the challenge with the all bigger mills. So I don't see any structural threat to the secondary market. Only thing, they have to be competitive. They have to be innovative in terms of giving the service, and maybe on the long term they will also have to work on their costing so that they can reduce their costing, because on the market side they will not be able to face the prices which the primary steel command in the market.
Sure. Okay. And maybe we just take a look at demand generation. There's a question here in the Q&A box about how much steel demand is from government or industry. So how much is the state leading the generation of steel demand, and how much is it private enterprise?
You mean to say the demand generation from the government projects?
Yeah, how much is the state, how much government projects, or what proportion of total demand is driven by state projects?
So it's very difficult to bifurcate the demand between the government projects and the private segment. But if you see, primarily the government demand comes from the infrastructure projects. And if you look at the overall consumption pattern sector-wise, the infrastructure segment consumes around 30-35% of the overall steel in the Indian market. So put together, maybe not more than, I would say, around 50-55 million tons annually from the government projects.
Okay, thank you. Um, okay, time is cracking on, and there's a few subjects still to cover. So I'd like to turn to Sahita. Sahita, you wrote an excellent feature in our latest Steel Intelligence India about the development of import policy in India. Can you tell us a bit more about that?
Yeah, so currently India is a net importer, but the government has issued several trade defense measures. I talked about it very briefly in my presentation, but I delved deep into in the recent feature. What it shows is that while India is a net importer, according to recent data, it's less finished steel, and most of the material is coming from stainless and alloy. So there's more material coming in for specialized grades or stainless grades, which is where India needs to build more capacity. So the current trade policy that the government has targeted is the CRGO anti-dumping duty, where there's a probe on China, Japan, and Korea. The other one is on HR flats to further target China, Japan, and Russia as well. It's in addition to the ongoing safeguard duty to limit more of these imports. And most recently, it's the domestic procurement policy, where previously it was about 50% value-added steel, and that's been modified to a melt and pour rule. So all of these combined is expected to limit more imports coming in. But it really, it's less a factor of cheaper imports and more a factor of India also building its capability for specialized grades, which I think most of the major mills are already investing in. I know the recent capacity expansions by all of the major mills is focused on building out or providing more plates or heavy plate material and galvanized coils to cater to these higher value grades. So India is building it out, but it's a transitional phase So it's a temporary phase while India still needs to build on it. So it's a temporary phase. In the next couple of years, India should have sufficient capability to not require as much specialized imports grades.
Great, thanks. And sticking with you very briefly, in terms of the kind of short range market outlook for the rest of this calendar year or financial year,
Yeah.
how do you see prices moving? I'll put it to the other.
So actually, prices have already been on a mild upward turn in the last few weeks or so. And for the coming months as well, once September begins, prices are expected to increase by about 1,000 to 1,500 rupees, at least for September. And that's expected to be maintained for the quarter, maybe rise a bit further. So that's primarily because a lot of activity will return once monsoons are over and all of the pent-up demand will come back up and it'll be roaring demand once again. Typically Q3 and especially Q4 is when demand is especially strong because governments need to meet their annual expenditure budgets. So a lot of infra activity picks up severely. So yeah, prices are expected to increase by at least 1,000 to 1,500 in the next month at least. Yeah.
Thanks. Does anybody else want to come in on market outlook for the next few months? Anybody want to put some
Maybe Thomas,
questions out
I
there?
will also I will also add. So as Suhita mentioned, I am also quite positive in terms of the demand for the balance financial year. We have already witnessed around 7% consumption growth in the first 4 months of this financial year, and I expect the similar growth to continue in the balance year. However, I'm not very optimistic on the prices. It's not because of the demand, but also if we see the India keeps adding the capacity, and if the in for any region, if the growth in the capacity is higher than the demand, because the demand is growing by 7 to 8%, where the additional capacity is by 9 to 10%. So we will see some surplus capacity in the market in the short term. So prices might come under the pressure. In terms of the steel industry margin also, which also linked to the prices. So because of the geopolitical uncertainty, the uncertainty in the raw material prices, so the margins may also come under the pressure. So yeah, that's my outlook for this current financial year.
Thanks. Interesting. So quite a lot of pressure coming over the next few months. And do you think that much of the world is more vulnerable to this kind of inflationary pressure? It seems like a lot of markets that have shut themselves off have very protected margins now, thinking in North America and Europe at the moment. Do you think that is giving them an advantage? Mr. Agrawal, do you want to come in on that?
Maybe I would request Vikas or Ashwini to comment on this if they can.
Sure. Mr. Lamas Naha, who wants to come in?
Yeah, so I think the prices will improve because of the raw material prices are increasing continuously, and this will definitely support the price increase. Also, yes, as we earlier discussed, that a lot of restrictions are coming up in the global market, and which will also support this price increase. So, and particularly to EU region, the demand will come up as soon as the holidays will be over, and the demand will come up, and the supply crunch will be there because of the TRQs. And yeah, so all these factors are supporting the price increase in the upcoming months. Yes.
Thank you. Mr. Lal, any additional comments on market movements?
I'll just try to make the comments that Vikas and Rahul already made. So we are talking one about India and the other is about international. So India, we have both cost push and demand pull. I think I will count both of them together, and which is in line with what Vikas just said. In spite of the monsoon season, we have not seen drop in prices. Rather, we have seen increase in prices, unlike previous years. So the demand story in India is continues to be good. Having said that, I think either Rahul or Vikas mentioned that the capacity expansion is higher than the demand expansion. So there will be cycles or there will be situations of crisis where, as exporters, we will need to play a role of getting material out of the country. So India's story remains good and it is in a comfortable situation. As far as international business is concerned, yes, there are many walls coming across the world. But I think, like I said earlier, the walls are higher for Chinese exports than for Indian exports. We have our reputation to keep in Europe, and that will continue both in downstream and upstream. India, as a manufacturing country, I think we will also look for value added engineering exports to increase. That is likely to happen where there is no quota, etc. So those things are already playing in the mindset of exporters or the Indian industry. It's not particularly steel, but also steel and onward industry. So the engineering exports is going to be increasing from India, which is obviously linked to many other schemes that the government of India is bringing. So I think we are not as uncomfortable as it sounds to be. India remains a good story, and as exporters, I think we need to find the right markets and create the right value for our respective companies. While Suhita said that the government of India is desperate to meet their targets, I think all of us also have our targets to meet. So there's nothing that taking away from that. So we will play our game, and we know how to play that game. I'm sure.
Thank you. Yeah, great. All right, we're getting quite close to the end, but there's a couple of things we haven't really covered. We covered green steel in the context of CBAM, but not really domestically in India. So, Mr. Agrawal, I wonder how you see the development of green steel demand in India.
Hi, Thomas. So this is the most talked about topic globally. I was going to the question and answer. I saw one question: what is the definition of the green steel? So maybe I will just try to answer that question first, and then we'll come to the your question. So as such, there is no definition adopted globally for the green steel. But if you see, the Indian government has introduced the green steel taxonomy in 2024, where they try to define the green steel. So any steel which is produced with the carbon emission of less than 2.2 ton per ton of the finished steel, we call it as a green steel in India. And just for the audience information, so the global average carbon emission is 1.9 ton, whereas the currently the Indian CO2 emission is somewhere between 2.6, 2.7, primarily because we are more on the coal-based DRI route. In terms of the demand also, Thomas, so I would say it's a very complicated to say the demand, because demand is also linked to the pricing of the green steel. So if we look at the manufacturing process which we need to have for the producing the green steel, so primarily there are three pure process. One is the basically the natural gas based, the 100% scrap based electric arc furnace, and the hydrogen and the solar. And every process require the huge capex, huge investment, where the your costing for the steel production goes high. On the other side, when it comes to the buying decision, I don't shy in saying that the consumers or customers are still reluctant to pay you that premium. In terms of the pricing, your pricing goes by somewhere between 20 to 50% depending on the carbon emission level. But the consumers are not willing to pay more than 50 to 100 dollar per ton in terms of the rupees, not more than the 8 to 10,000 rupees, if they get any specific advantage in terms of their financing or the loan from the bank. I would say the demand will increase gradually, but then it also needs the lot of push from the other factors in terms of the government policy also. So government has already, Indian government has particularly already made the policy to have minimum amount of the green steel in your projects. But then again, lot needs to be done from the both side in terms of the manufacturing. Also, we need to develop the technology where the cost can come down and make the viable option for the green steel, and the buyers also have to come forward to pay the premium on the steel. So my opinion, maybe in next 3 to 4 years, the demand for the actual green steel would be around 6 to 7 million ton. That's my say on this.
Thank you. Yeah, so it's interesting to have a real number on it. And so obviously it's a small proportion of the total market, but it's meaningful to have that as part of the market. We're coming very, very close to the end now. I did just want to ask Gabriel one question on CBAM while we have you here about the process of verification, because I know you've said 6 months to verify. Do we know how close the EU is going to at it this time in terms of releasing the names of the verified suppliers, and how much of a rush is it going to be? And the follow-on from that is, what proportion of the industry do you think has pre-verified? Positive responses from the mills here, but what proportion do you think are ready?
So the simple point is that the verifiers will be accredited from next month. So I think we will get out of the stupid period where we don't know who the verifiers are going to be fairly quickly. But the important point is about the limitations of pre-verification. Pre-verification is very useful. Okay, it means checking your 2025 numbers, checking you have a process according to that old system. But from 2026, your numbers are not enough. What is also going to be audited is your monitoring report, your monitoring plan, which is a full documented process of how you go about getting those numbers. And the verifier is your friend, but not your ally, I suppose, right? You employ them, but they are auditors, and they cannot work through the process of how you put that monitoring plan together with you. And the pre-verification will be about checking that your numbers add up, and they will give you false confidence if you think that you've then got yourself ready. Because if you go into the 2026 verification cycle without a fully documented process in a monitoring plan, you will fail verification on day one. Okay, so I do think it's important to remember, verifiers cannot consult, they cannot advise, they can only check your working and give you a yes or a no or a thumbs up. And the same applies to pre-verification. And we do see companies who have got the verifier and who therefore believe that they've got everything sorted out. And I would encourage them just to dig into what's needed for the monitoring plan and talk to people who can consult with them and work them through that process. And there are many of them available.
Thank you. Good advice there. Okay, we advertise an hour and we're at an hour 15, so we are going to have to call it a day there. Thank you, all of you who put questions into the box. We will try to give you some responses to some of those questions separately, but do also please feel free to reach out to me or Sahita or anyone at Kallanish if you have other questions that you would like to ask, and we will continue that conversation with you. I'd like to remind everybody before we go that the PowerPoints and the recording of the session will be made available via an email link tomorrow. In that email, there will be a short feedback survey with 4 questions, very quick, very simple. Please do answer them because it does help us shape our future webinars. And finally, I'd just like to thank my panelists. Thank you, Gabriel Rosenberg, Ashwani Lal, Vikash Nahar, Rahul Agarwal, and Savita Pradar. Thank you very much, and we'll see you next time. Thank you.
Thank you.